Hello, all my dear students. How are you all? Hope so. All you are fine. Now, today we are going to complete the depreciation chapter of the course. Okay. So, everyone, just be with me and confirm that are you able to see the video, audio, as well as the screen is visible to you. Okay. So, today we are going to finish up the remaining methods of depreciation. For the remaining methods of depreciation, we are about to start one method which is called revaluation method of depreciation. So this is a very simple method of the depreciation chapter till now which you will come across, because every other method, the WDV one or I would say the SLM one, that was the method which we did, but that was a typical one. The revaluation one is very simple one. I will just give you an example. Let's say there is a farmer. There is a farmer. So farmer used to have livestock as their assets. Livestock means what? They have cow as their asset. Okay. Or let's say it is a normal shopkeeper who has some cans. Cans means what? We drink the Coca-Cola, Pepsi in a can. Okay. He has the can as an asset. And obviously these assets are quite a large in number. For example, he has a stock of 10,000 cans. So when these cans are kept together with each other, some get automatically crushed. When these are kept together, some get crushed and they are of no use. They are of no use. And some which are of use, they can be used into the business. So here, if I want to apply the depreciation on this asset, the can or the cow as a livestock, so it is very difficult to find what should be the depreciation. Now, what the question will give you the information. For example, Mr. X has 1000 cans costing rupees 5,000. Okay, Mr. X has 1000 cans have costing 5,000 rupees. He purchased 2,000 more cans, which is costing rupees 12,000. At the year end, at the year end, the value of cans available was rupees 10,000. Find out depreciation. Find out the depreciation. Okay, so if this is the example which is given to you, now what you have to do, very simple thing, very simple thing. Just prepare your can account. Okay, like for example, there is a machine, so I am preparing the machine account. Here you have a can, so you are preparing a can account. Now just focus on what I am doing right now. So here the opening balance has 1000 cans, which was costing of 5,000. So I'm just writing over here to balance brought down of 5,000 rupees. This is the amount column. So we have balance brought down of 5,000 rupees, which is the opening one. Then he purchased additional 2000 can, which was costing how much? 12,000. So for example, he has purchased it to bank account and he purchased it for 12,000. Now at the year end, what is the balance available? That is rupees 10,000. So that is the closing balance which is already given in your question. That is the closing balance which is given in your question. So I would write by balance carried down, that is 10,000. So whatever is the balancing figure that would be charged as your depreciation. So what is the total here? Here it is 17,000, 5,000 plus 12,000, 17,000. Here it should also be 17,000. So whatever is the balancing figure, that would be your depreciation. So here 7,000 is charged as the depreciation and it will go to your P&L account. It will go to your P&L account. So this is something we have done, a revaluation of asset. Originally the asset was of how much? The asset was of 17,000, but at the year end we found out the value of the asset is only 10,000 left. So what we did, we charged the remaining amount as a depreciation and we have booked it into the profit and loss account. So your P&L account will show depreciation of 7,000. So we have done nothing but we have charged the depreciation into our P&L account. So it is a very, very simple method which I already told you, right? So this method is very useful when you don't know the quantum of the assets, but you know the value at the year end, at the opening, and all the purchases or the sales. That is a revaluation method. Okay. Was it simple? Yes or no? Yes. Okay. Perfect. Now let us do one question based on this. So we have a illustration 7 on page 191 of your notes. Illustration 7 says that on 1st of January 2020, there was a stock of bottles of 8,000. So opening balance is given, to balance brought down in your bottle account is 8,000. On 1st of July, they purchased additional bottles amounting to 5,000. 1st of July, bank account 5,000, the additional bottle which are purchased. On 31st December, the entire stock was revalued at 10,500. So balance carried down 10,500. So whatever is your balancing figure, that would be your depreciation, which will be just 2,500. Same thing we did. So that was an easy example for your revaluation that we completed. Now let us go to the depletion unit method. Depletion unit method says that instead of taking the useful life as the denominator, consider the estimated life in terms of production units. In terms of production units. Why this is saying? Because some machine comes with some conditions. For example, when I purchased this machine, they said only 10,000 units can be produced out of this machine. Machine has a limitation on its output. Only 10,000 units can be produced out of this machinery. So for example, I purchased the machinery for rupees 1,10,000. Residual value is given in the question. It is 10,000. Number of units machine can produce is 5,000 units. Following is the information given with respect to units produced. So following is the information given with respect to the units produced. So we have year and we have units. So in 2020, I have produced 1000 units. In year 2021, I have produced 2500 units. And in year 2022, I have produced 1500 units. So total 5000 units have been produced. Now you have to calculate depreciation on machine each year. So as per the traditional method, what would I have done if this is used for only 3 years? This is used for only 3 years. So what would I have done? I have taken the cost minus residual value divided by the useful life if it is the 3 years. So in this case, it would be 1 lakh divided by 3, that is 33,333.33. So as per SLM method, this depreciation will be charged on the machinery. But now the question says there is no information on the useful life, but there is information on the number of units which the machine can produce. So I have a capacity of 5000 units which the machine can produce. So let's replace the life, the denominator, by the number of units which the machine can produce. So our calculation would be 1,10,000 minus 10,000 divided by 5000 units. And this would be 1 lakh divided by 5000. It would be rupees 20 per unit. So if the company has produced 1 unit, then 20 rupees should be charged as the depreciation. So what I have calculated, I have calculated the depreciation per unit. So in year, if in year 2020, 1000 units is produced, so depreciation per unit is rupees 20. So total depreciation would be 1000 into 20, 20,000. Okay, then 2500 into 20, that would be 50,000. And here it would be 30,000. So this way, whole 1 lakh will be written off in the 3 years based on the units which are produced, because the machine is being depleted based on the units. Okay, so coming back to your example, to your explanation, so depreciation per unit would be acquisition cost, that is cost of acquisition, minus the residual value divided by the estimated life in terms of production units. So that is the same which we have discussed right now. Moving on, if you see the illustration 9, it is the same method which is given. So try to solve it at your home. That is very, very, very easy. That is your homework. Okay. Then I will come to the most important topic, that is provision for depreciation account. Let us go to our notes to understand the concept before doing the reading the book or doing the questions. So what was the traditional method? Let's take a very, very simple example so that I can cover every logical point which I need to cover right now. Okay, let us take a very, very simple example over here. So as per the traditional method, it was said that if I have purchased one machine and the cost of the machine was, let's say, 1 lakh rupees only. One machine is purchased, the cost is 1 lakh. The useful life is 2 years. The method of depreciation is straight line method. Can you calculate depreciation per annum? Yes, sir. Depreciation per annum should be your cost minus residual value divided by the life. of the asset. So cost was 1 lakh. There is no residual value given, so I will write it as 0. Okay, and this whole will be divided by the life, which is 2. So the depreciation per annum would be rupees 50,000 per annum. This is the very simple example. But now let's go to the balance sheet presentation of this. Let's go to the balance sheet presentation and the P&L presentation of both the years. This was purchased in year 2020. So obviously I will need two balance sheet for year 2020 and balance sheet for year 2021, and I will need P&L for 2020 and I will need the P&L for 2021. So four things I am preparing simultaneously over here. So if you see on the first year in 2020, if I purchase the asset, I have purchased the asset. So this would be 1 lakh rupees when the asset is purchased, and then the depreciation will be charged for that asset. Depreciation will be charged for that asset. So the value will be 50,000 of the depreciation. So on the asset side, only 50,000 will be shown. On the asset side, the value of the machine will be shown as 50,000 rupees. And in the next year, what will happen? We will again charge the depreciation and asset will be of 0 because the value was 50,000, and then in the second year also we will charge the 50,000 rupees depreciation and the value will become 0. That is what we do normally. This is the traditional way which we are doing. In PNL also you will see the depreciation of 50,000 which is charged, and here also the depreciation of 50,000 which is charged. This is the normal way. But the accountant said that this is not the good presentation. This is not the good presentation. There is one more presentation where what you can do, you can collect all your depreciation into one account. What you can do, you can collect all your depreciation into one account, which will be known as provision for depreciation account, which will be called as provision for depreciation account. So basically what the journal entry I was doing it till now, when the asset is purchased, so it would be asset account debit to bank account. That is when the asset is purchased. Then when I charge the depreciation, what I do, I will do depreciation account debit to the asset account. And then I transfer the depreciation to the P&L, then P&L account debited to depreciation account. So in this way, I was closing my books of accounts. Okay, so in our example, the asset was purchased for 1 lakh. So bank 1 lakh being credited. Depreciation for the first year was charged as 50,000. So asset account will be credited by 50,000 and depreciation will be debited by 50,000. And then depreciation will be finally transferred to the P&L account for 50,000 rupees. Okay. That was the traditional practice which I was doing earlier. But now what we will do? Now they say in your balance sheet, show your asset with the original amount. Show your asset with the original amount. That is of 1 lakh rupees. And instead of depreciation, write it as provision for depreciation. 50,000, which we will deduct, and the net value will come out as 50,000. Even in the next year, this was the balance sheet for 2020. And even in the next year, what will happen? You will not remove the asset. You will show the asset. You will show the asset, that asset I have purchased for 1 lakh only. And now the provision for depreciation will be of now 2 years, not just 1 year. So it would become 1 lakh rupees. And net value will be 0 outside. Net value would be 0 outside. That is the depreciation presentation which is changed. Nothing else is changed. So what change I need to do in the journal entry? So instead of reducing the value of the asset, we will transfer the depreciation to an account called provision for depreciation account. We'll transfer it to provision for depreciation account. And then P&L transfer is the same. Only this account will be created and your first entry will also be remain same. So that is the change which we are doing in the provision for depreciation account. So what exactly is happening? We are accumulating the depreciation of every year 1, 2, 3, and 4 into one of the account called provision for depreciation. So let us change one example and see let's how the provision for depreciation account works. So I have purchased furniture rupees 40,000. Scrap value is nil. Life is 4 years. Life is given as 4 years. You have to provide depreciation as per the provision for depreciation method. So what you will do, let's first do the journal entries. When the furniture is purchased, so it would be furniture account debited with rupees 40,000 to bank account rupees 40,000. What would be the depreciation per annum? Depreciation per annum would be 40,000 is the cost minus the scrap value divided by 4, that is the life. So that should be 10,000 rupees per annum. That should be 10,000 rupees per annum. What I will do in the furniture account? Nothing. We have to keep the furniture at the cost, at the level it was purchased. It will remain at 40,000 only. So sir, where depreciation will go? Better depreciation will go to the provision for depreciation account. This is for the first year. We are charging the depreciation. And finally, your P&L account will be debited. And that would be for the depreciation account. So if you see here, your depreciation account is being debited here and it is being credited here. Okay, so depreciation account is knocked off, but this is not knocked off. This we need to show in the balance sheet as a negative to the asset. So let's see how the presentation will go through. Let's do the presentation now. I will leave some space for the entries for the next year. So let's say if we have the furniture account, then we will have another account called provision for depreciation account, and we will have depreciation account, and let's also prepare the P&L account. Okay, we are preparing the 4 accounts. So first we have prepared the furniture account, then we will have the provision for depreciation account, then we will have the depreciation account, and then we will have the P&L account. So let's say my first year is 2020. I have purchased the asset. So to bank account, the asset was purchased for 40,000 rupees. So my furniture account would be debited by 40,000 rupees as it is showing right now on your screens. Okay, now at the end of first year, what I'm going to do at the end of the first year, my depreciation will be charged not from the furniture account, but from the provision for depreciation account. So how we are going to present that? Just see. Now we will go to our depreciation account. So everybody know for charging the depreciation, we need to debit the depreciation account by 10,000. So instead of writing the furniture account here, what I will write? I will write provision for depreciation account. So in your provision for depreciation account in 2020, what will happen? Balance will come from depreciation account as 10,000. And your depreciation account will be closed. It will be balance will be transferred to the P&L account. Sorry, not 20, but 10,000. Here also in your P&L, the depreciation will be charged 10,000. This was all entries for 2020. The depreciation account is closed over here. Your provision account, provision for depreciation account will be closed by writing here to balance carried down. So this 10,000 represent the depreciation which is charged till now. This 10,000 represents the depreciation which is charged till now. And your asset will also be shown as by balance carried down 40,000. So in your balance sheet for 2020, how the presentation will be there. So on your asset side, there would be furniture of 40,000 and you will show minus provision for depreciation. So what was the balance for provision for depreciation in the first year? Sir, the balance was here, balance carried down was 10,000 rupees on the left. So that would be deducted from your furniture account and net 30,000 will be shown in the amount column. That is how the presentation would be for 2020. Now, moving forward for the next year, the first entry is same. The second and third entry will repeat again and again. So this was for 2020. Now it is 2021. So there would be fourth entry that depreciation account debited for rupees 10,000 to provision for depreciation rupees 10,000 and fifth we will transfer the P&L 10,000 to depreciation account 10,000. Okay, so there would be no change in my furniture account. Only the balance carried down will be brought down in 2021. So to balance brought down, it would be 40,000. See, there is no change in the value of the asset. It is the same. The value of the asset is same. But in depreciation account, this was year 2020. Now in 2021, again depreciation would be charged to provision for depreciation account. 10,000 rupees will be charged. Okay. And in my provision for depreciation account in year 2021, by depreciation account. Okay. Before depreciation coming over here, we will transfer the balances also. We will transfer the balances. So what was the balance? The balance carried down was 10,000. So this balance will be brought down over here. The balance brought down 10,000. So now after 2021, what is the balance of my provision for depreciation? What balance will be carried down? The new balance is 20,000. So what 20,000 represents? It represents the depreciation for year one, 10,000, and also the depreciation for year two, that is 10,000. So in my balance sheet, what it will be looking like? So if I go to my balance sheet here only, the year would be now 2021. Furniture will be at 40,000 only. But now provision for depreciation account would be 20,000 instead of 10,000, and my overall balance would be 40 minus 20. On the amount column, it would be 20,000 in 2021. Okay, so everything is same. Whole concept is same, but what we are doing, we are accumulating my depreciation into provision for depreciation account. Am I clear, everyone? I will do for rest of the 2 years also, so that it is very, very clear. Now let's do it for 2022. So this would be sixth entry, depreciation account debited 10,000 to provision for depreciation account 10,000, and then P&L account debited with 10,000 to depreciation account 10,000. This is the seventh entry. In furniture account, again, we will do buy balance carried down. Nothing was sold. So this is closed in year 2022. To balance brought down again 40,000. Nothing was charged. So again, to balance carried down at the year end of 2022, it would be 40,000 again. Here you can see we have already transferred the balances. Now in 2022, buy balance brought down. So this balance will be brought down in the next year, which is 20,000. Again, depreciation will be charged for 2022. It is 10,000 rupees. So now the provision for depreciation account will have a balance of 30,000, and it will include your 3-year depreciation. In the depreciation account also, earlier year it will go to P&L account. So your earlier year was closed. Now we will go to 2022. To provision for depreciation account 10,000 rupees, by P&L account 10,000 rupees, and it is closed. Here also in 2021, to depreciation 10,000 closed, and in 2022 in your P&L account again to depreciation 10,000 closed and closed. So coming to the last balance sheet part. So my balance sheet for 2022 will show the provision for depreciation at 30,000, because now 3rd-year depreciation is also charged, and in the amount column your asset will be remaining at 10,000, but here furniture account will remain same at 40,000 only. So what we are doing, we are writing the gross value of the fixed asset, and we are subtracting the accumulated depreciation. We are subtracting the accumulated depreciation from it, and then we are writing the net value of asset. We are writing the net value of the asset. But in the earlier case, we were changing this amount, we were changing the gross amount, but the gross amount should not be changed as per the provision for depreciation method. Are you able to understand this? Is there any doubt? Okay, now last year, again the same thing for 2023. Your eighth entry and ninth entry would be again depreciation debit 10,000 to provision for depreciation 10,000, and lastly P&L account debited with 10,000 to depreciation account 10,000. So now if you look at your furniture, to balance brought down would now again be 40,000, and same will be carried down. Same will be carried down. So this will be closed over here. In your provision for depreciation account, again in 2023, the balance will be brought down at 30,000. Current year depreciation will be charged at 10,000. and the total balance which will be carried forward, that would be 40,000. But technically this asset is now over. It is over. We can write it off from the books of accounts. So we will see that how we will do it from the books of accounts. Here, to provision for depreciation, again 10,000, and it will be transferred to the P&L account, 10,000. In P&L account 2023, to depreciation 10,000, and it is done. But now, if the question specifies that the asset is disposed of, it means it is scrapped. Now, what we can do? Now, before closing the fourth year, instead of writing balance carried down, we will transfer the whole asset balance to account called asset for disposal. We will create one account called asset for disposal account, and my provision for depreciation account, which is carried forward 40,000, this will be also transferred to the asset for disposal account. So basically I will do some additional journal entries. I will create one account called asset for disposal. Whenever we are going to sell the asset or we are going to dispose of the asset, this account will be prepared. And here the balance will come from the furniture account. So furniture account has a balance of 40,000, and my provision for depreciation account also had a balance of 40,000. So whatever was the balance, it is knocked off against each other. But if they say, asset was disposed of for rupees 2,000, so we expected we will have a zero scrap value, but I have received 2,000 from selling this, so I will credit that we have received this into the bank account. So we have received 2,000 rupees over here, and this will be my profit on disposal. Profit on disposal, because we assume that nothing would be left. So this would 2,000 would be my profit balancing figure, and both sides will be tallied. So this is how we will calculate the profit and loss on disposal. Let's say another scenario I will give. The asset was originally of not 40,000, it was of 45,000, and we have charged the depreciation of 40,000 only, and we have received 2,000 rupees in the bank. So on the credit side, on the debit side, you have 45,000 as the total, and here also it should be 45,000. So remaining 3,000 is the loss on disposal. So remaining 3,000 would be the loss on disposal. Whatever is the profit or loss, it will go to your P&L account. If it is a profit, it will go on the credit side as profit on disposal, and if it is a loss, it will go on the debit side as a loss on disposal. Rest everything is same. Rest everything is same. Did you got that concept? This is very, very easy, but this might look typical when you are looking at the first time, but whenever you solve the questions, it will become very, very easy. Did you got the concept, or you want me to uh, recapitulate any of the point which is discussed? Is it clear? Speak up, child. All clear? Any doubt? Okay, perfect, sir. So let's go to your notes. What is given? So same entry we have seen, asset account debit to bank account whenever the asset is purchased. Whenever we will charge the depreciation, it will not go to the asset account, but it will go to the provision for depreciation account in this method. It will go to this account. Okay. Then whenever the asset is sold, the cash or bank account would be debited, and they have used the asset sales account instead of asset for disposal account. That is one and the same thing. The name is different, but everything is same. In the same way, you will transfer the asset to your asset disposal account, and you will transfer the provision for depreciation to that account. Any profit and loss which will be arise on the sales of that asset will be transferred to the P&L account. That is covered into your disposal of asset. That is asset disposal account debit to asset account, provision for depreciation account debit to asset disposal account, and then for charging of depreciation account debit to asset disposal. And when you have received any cash, so bank or cash account debit to asset disposal. And if there is any loss, so P&L account will be debited, asset disposal account will be credited. If there is a profit, asset disposal account will be debited and P&L account would be credited. Simple funda. If it is a loss, so P&L debit, because you need to debit the gains, sorry, expenses and losses. And if it is a profit, so P&L account will be credited, because you need to credit the gains and income. Okay, so that was all. Illustration number 9 will be your in your homework. That is the same type of question where we need to prepare the machinery account, you need to prepare provision for depreciation account, and you need to prepare the machinery disposal account. So this is a very, very interesting part, or I would say interesting question. If you want to try it right now, you can try it, or you can do it in the homework, whichever method is preferable to you. What do you want to do? Tell me. Do you want to try it now, or you want to do it in your homework? The majority which will say in the chat box that I'm going to do. Then we have some simple topics left, which we are going to cover today. One is again not very simple, but yeah, we can say that it has some concept which is involved, which we are going to discuss. Okay. Then we have profit and loss on sale of asset. It is the same thing which is done already. What is this? The asset disposal account, the if any cash is received, so cash and bank account debit to asset disposal. The depreciation will be charged to the asset disposal account, and any profit or loss which is arrived from that, it will be transferred to the P&L account. And we have the alternative approach. We were doing the traditional approach, I would say. Cash and bank account debit to asset account when we have received the cash. In case of depreciation, we were crediting the assets account and charging the depreciation directly to the asset, the earlier method which we were doing. And if there was any profit and loss, we are transferring it to the P&L account. So that was the old method which we were doing. So both the methods are applicable and the same. Based on the old method, there is also a question which you can cover it up in your homework. Okay, this is already discussed and we have done many questions on that. Now, if there is a change in method, the change can be prospective as well as the change can be retrospective. The change can be prospective as well as the change can be retrospective. What do you mean by prospective? That means from today onward, the change will be applicable. For example, let's go to the example. I purchased a machinery for 50,000 rupees. I thought, I thought the life of the machinery will be 2 years. I thought the life of the machinery will be 2 years. Now, what happened? What happened? After 1 year, we found that machine can be used for additional 2 years. So now already 1 year is passed. So in year one, what you would have done, you had a machine account where the balance was 50,000 and you found out earlier the life was only 2 years. So you charge the depreciation of 25,000. You charge the depreciation of 25,000. So after 1 year, when the depreciation is charged, now the balance, the WDV of the machine was rupees 25,000 only. Now you know that this can be used for 2 additional year. So 1 year was left, now 2 additional year. So the new life of the machine is 3 years. New life of the machine is 3 years. So now what I will do, I will recalculate my depreciation. It would be 25,000, the WDV, whatever it is left, whatever the WDV is left, that would be divided by 3 years. So now I will not charge the 25,000 of depreciation, but I will charge 25,000 divided by 3. That would be 8,333 rupees. So in the second year, I will charge the depreciation of 8,333 and balance after 2 years would be 16,667. And now again, third year, the depreciation would be 8,333. The last balance will also become 8,333, and fourth year the depreciation will be charged again 8,333, and thus it will be of zero value. So this is called a prospective change. Okay, that this is called a prospective change. But if they say I want to implement this change right from the first year, right from the first year, that is called a retrospective change. Prospective means from current year. From current year was second year. Okay, but if there is a prospective change, it needs to be done from the year one itself. So from year one, original value of the machine was of 50,000. Original value of machine was 50,000. So if the machine had a life of 4 years, if a machine had a life of 4 years, what should be the depreciation which would be charged per year? It should be 12,500. It should be 12,500. Now we are currently, the 1 year has been crossed and we have charged the depreciation of how much? 25,000 I've already charged. So now in the second year, as per the revised calculation, in the first year 12,500 should be charged. In the second year again 12,500 would be charged. So in total 25,000 depreciation should be charged by year 2. But as we have already charged 25,000 in the first year itself, now you need to charge zero depreciation in this year, and now your WDV will be 25,000. And in the third year, again 12,500 will be charged. Your balance would be 12,500. And the fourth year, again 12,500 will be charged. Your at the end balance would be 0 rupees. So this is called retrospective change in the method. But is it legal to do that? Now come to your notes. So there is an accounting standard which is 6. AS6 says depreciation method selected should be applied consistently from period to period, but change in method of depreciation should be because of the below situations only and only. So if there is any statute, there is any law which is saying to change the method, then we can do that. We can do for compliance of the accounting standards, for more presentation, for more appropriate presentation of the financial statement, it can be done. And change in method can be done in only two ways, that is prospective effect and the retrospective effect. If I say about the prospective effect, the change in method is to be taken into consideration for the rest of the useful life, not from the start, but from the rest of the useful life, commencing from the year in which such change is effected, not from the beginning of the year. So you can see there is one example. Rise Limited purchased a machine of 1 lakh on 1st of January 2017. The machine was depreciated at 10% per annum as per the straight line method. So, as per the straight line method, in the first year, the depreciation should be 10,000 rupees. So, the balance after 1 year would be, at the first year would be 90,000. What are they saying? On 1st of January 2020, that means 3 years are passed. So, after 3 years, the WDV would be 80,000. And then again, 10,000 depreciation would be charged. The W would be 70,000. WDV at the third year. Okay, this should be 70,000. On 1st of January 2020, the company decided to change the method of depreciation from straight line to diminishing balance method without retrospective effect. That means from now onwards, it will be charged at diminishing value. So you have a WDV of 70,000. Now the 10% will be applied on 70,000. That means for the fourth year, the depreciation would be 7,000 rupees. So if you can see over here, every year the depreciation in your books was earlier charged at 10,000, 10,000, 10,000. But from 1st of January 2020, the balance was 70,000. We have changed the method prospectively. So now the depreciation is calculated the 10% on 70,000. And this is how it will go on. That is called prospective change. Even you can try to solve illustration number 23. Illustration number 12. That is your homework. It is a very, very simple way. Okay. Now let's go to the retrospective way when the method is changed, not just the life. We have here for simplicity, I have taken just the example of the life change, but here the method is changing. So what is the procedure to do that? Let us read it first. The depreciation should be recalculated by applying the new method from the date of acquisition or installation. That means from the start of the asset. The difference between total depreciation under the new method and the accumulated depreciation under the previous method till the date of change will be the surplus. That may be the surplus or the deficiency. Whatever is the surplus, it will be charged back to the P&L account as the depreciation written back. Okay. And if there is any deficiency, it will be charged to your P&L account. So if the old value is less, the P&L account would be debited and asset account would be credited. If the old value is more, the asset account will be debited and P&L account would be credited. The above change of depreciation method should be treated as change in accounting policy, and its post effect should be disclosed and quantified. That means it needs to be disclosed in our notes to the accounts and to the shareholders who are reading the financial statements. Okay, so that is the presentation wise. There is one example on this. Let us do this. RAM Limited, which depreciates machinery 10% on the diminishing balance method, had on 1st January 9,72,000 on the debit side of the machinery account. We have 9,72,000 on the debit side of the machinery account. During the year 2020, machine purchased on 1st of January 2018 for rupees 80,000 was sold for rupees 45,000, and on 1st of July 2020 a new machine at a cost of 1,50,000 was purchased and installed at the same date. Installation charges is 8,000. So we will add that installation charges. The company wants to change the method of depreciation from diminishing method to straight line method with effect from 1st of January 2017. That means from the start date when the original machine of 9,72,000 was purchased. Difference of depreciation up to 31st of December to be adjusted. The rate of depreciation remains the same. That means the depreciation rate would be 10% only, but instead of diminishing, there would be straight line method which should be used. So accordingly, we need to calculate the depreciation. Okay, so that is the reverse calculation they have done. 9,72,000 was the balance as on 1st of January 2020. So if I want to calculate the cost, I need to divide it by 9 and multiply it by 10. Sir, why divide by 9 and multiply by 10? Because the depreciation was charged at the rate 10%. So whatever is the amount remaining, that is equivalent to 90%, because 10% was charged as depreciation and 90% means 90 divided by 100. This 100 will come over here in multiplication. So this will become 9,72,000 divided by 90 multiplied by 100, and here 10 will cross out from this. So I can say 9,72,000 multiplied by 10 divided by 9. This I have done. So I got the value of machine 1 year back, and again I did this because the asset was purchased on 1st January 2018. So it would be 12 lakh rupees. Okay, that was the date of purchase of machinery, 1st of January 2018. Okay, so from this whole purchase of 12 lakh, 80,000 was sold. So if I say I have to split this, see this 80,000, this is the purchase price, this is the depreciation, then we have the balancing amount, then we have the depreciation for another year. This was the value on 1st of January 2020. Now we can calculate the profit and loss. So this was the value as on that date. We charged the depreciation, we booked the sale of 45,000, and whatever was the loss, that is 16,560, that is transferred to the P&L account. Okay, that we did in that year itself. And depreciation will be calculated based on whatever is charged till now, whatever is charged till now on remaining assets versus whatever should be charged on remaining asset. So whatever is charged and whatever should be charged, the difference between that will go to the P&L account as a profit or loss due to retrospective change in your method. So here you can see that the adjustment is done by P&L over here, 12,000, 11,200, and depreciation is charged accordingly. Okay. So that is how we will treat this, the adjustments in your depreciation retrospectively. So I have not solved this in detail, but try to solve this yourself in detail. And if you encounter any difficulties, then we will solve it in detail later on. So that was the last topic of this. And after this, everything you have already covered. This is the theoretical part, that what do you mean by useful life, the formula for depreciation, estimated residual or residual value or scrap value, method of depreciation, change in useful life. Okay, change in useful life. I have given you one example today itself that we have done. If the life is changed, so what we need to do, we can change, consider that change as a prospective change. And then there is a AS10, which is called accounting for fixed assets. So fixed assets is nothing but the assets which you are purchasing. So that asset should be at the historical cost. Historical cost, that means, for example, I have purchased it for 10,000 and today its value is 12,000 in my books. Not in my books. The market value is 12,000 in market, but I will show 10,000 only in my books. I will not show 12,000. So that is the historical cost concept which we have studied in the chapter number 1. Okay. So that was all with regard to your depreciation. Everything is covered. Now in the next class, we are going to go to the topic called preparation of the final accounts, where we will prepare the balance sheet, P&L, trial balance, and some other notes to the accounts and cash flow statement. So those are the remaining topic. This is a very interesting one. Some of the concepts you have already learned in the chapter number 1. I have already covered in the chapter number 1. But if you have missed any of these topic, don't worry, we will cover it up again so that nothing is missed. Okay. Any doubt? Anyone? Any doubts? Okay. So that was all for your today's class, and next we will meet with the new chapter called preparation of your final accounts. Okay. Thank you very much. Bye all of you. Take care.